Part 2. Into Action. The 7 Support Activities. Finance. Finance is one of the key support services that an LSP needs to have in order to enable continued success and growth. As with the other support activities, finance does not actually add value to the process of executing and delivering language services for the customers. However, the finance team creates an environment where the teams carrying out the core functions can successfully do their jobs by making sure that they have the resources to grow. Growth requires investment and can be downright expensive. The finance support activity manages the books to make sure that there is sufficient capital to invest in growth activities while still maintaining a healthy profit margin. If an LSP is publicly traded or beholden to external investors, then the finance function becomes even more important. Public companies live or die on their financial health as reported in their quarterly reports. Let's look at how growth can be supported by the finance department. If the strategy is to grow business by winning new clients, you need to invest in sales and marketing. The more activity an LSP does in this area, the better their chances will be of winning new clients. Obviously, right? The next step, though, is that once these new clients are won, they will require investment to continue to grow. For each new client, an LSP will need to hire new team members, recruit and train the supply chain, develop quality management programs, and invest in CAT tools. This may not be a profitable venture from day one. There may be several months of expenses before work ramps up and invoices are sent. Then, it might be several more months before the clients pay those invoices. An LSP could very well do 6 months of work for a new client before they ever see a single dime. This investment requires cash on hand, and that means it is not enough for the LSP to be growing revenue. It also must make a profit, as this profit can be turned around to invest back into growth. It is the responsibility of the finance department to monitor the business and make sure that the company is growing in a profitable way, with a keen eye for margins. Finance and accounting practices vary from company to company, but typically this means watching 3 key figures. 1. Gross profit. Calculated by deducting the cost of goods sold, abbreviated as COGS, from total revenue. This can be a useful number to watch to make sure that the operational tasks are being carried out with efficiency. 2. Net profit. Calculated by deducting all other operating expenses such as general administration costs, costs associated with sales and marketing, and other overhead costs from gross profit. 3. EBITDA, abbreviated as EBITDA, stands for Earnings Before Interest, Depreciation, Taxes, and Amortization. This is useful particularly for public companies or companies that would like to attract outside investment, as it is a useful tool for external analysts to evaluate a company's performance. These figures can be calculated for any company by reviewing their financial statements, which are typically prepared every quarter. The finance department closely monitors these financial statements to make sure that the LSP is healthy even during periods of growth. LSPs that do not manage their finances properly are easy to recognize over time. Such LSPs are characterized by periods of healthy growth followed by a period of stagnation. They just cannot keep up with the growth, and so they either stop growing or start losing clients because they were not prepared to invest the necessary resources into maintaining that healthy growth.